Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by Paramount Residential Mortgage Group.
In today's mortgage environment, providing our wholesale community with the best combination of product, pricing, technology, and service is paramount to their success. PRMG, built by originators for originators.
Welcome to another edition of Master of the Markets. I'm Barry Habib at MBS Highway, created exclusively for Mortgage News Network. It's brought to you by our friends at PRMG. They're working for your best interest. We got past the crazy week. Oh my goodness. Something for everybody, right? We started off with housing data, and it was good. K-Shilo giving us appreciation levels of 3% year over year. Really good numbers all across the board. Very, very solid, as well as the numbers that came in on pending home sales. So all good stuff that we had seen for the housing market. Now, when we take a look at some of the big events that were market moving, we had a big triple header. We did get the Fed, which cut rates. We did get inflation numbers as measured by the PCE. That's the Fed's favorite gauge. And then we got the big jobs report. What a week it was, Halloween week. Well, here's what happened. The Fed cut rates as expected. I'm sure you know that, but mortgage bonds don't always perform well because what the Fed's trying to do is they're trying to spark inflation and increase activity within the economy by lowering borrowing costs. Because of that, sometimes longer-term instruments which care about inflation, like a mortgage, respond adversely to that because of the fear of inflation. Well, bond market hung in there okay. We actually floated into that because we thought it would. The very next day, which was Thursday, we got information on inflation, which was very tame. In fact, inflation numbers, at least measured by the PCE, lowered. They dropped down a little bit, showing that inflation levels actually subsided. So the bond market liked that. And then the jobs report was a little stronger than expectation, but the wage pressure that we can measure, see if people look at the wrong thing, which is hourly earnings, that actually went up. But you don't take home how much you make per hour. You take home how much you make per week. So you have to multiply that by the hours worked, and hours worked actually decreased. So therefore, wage gains remained steady at 2.7%. So the bond market kind of looked at that and said, hey, that's okay, even though jobs are stronger. Now, the interesting thing about this is the unemployment rate, which had bottomed out at 3.5%, but now we just ticked higher to 3.6. Nothing to really worry about initially, but if this persists and we start to see the unemployment rate tick higher and higher towards or reaches 4%, that would be a really good indicator that a recession would likely occur within 6 months. So that was the news of last week. Now, after getting that barrage of data, it's a quiet news week this week. Meanwhile, mortgage bonds improved on the week. We gained about 50 basis points. 10-year Treasury was a little bit lower on the week, and there are some important levels that we still need to watch. Watch 1.78 on the 10-year Treasury. We break above that, it could be a bit problematic. We're going to see if the 10-year Treasury can settle back in and come back down to some of the levels that we had seen. I think it treads water for a while. The Fed signaled that they're not going to probably do any more cuts for a bit. We're going to be data dependent. Remember now, the Fed funds rate is going to be between 1.5% and 1.75% right now. That's the Fed's target range, which means that if we do see a recession, how many quarter-point rate cuts does the Fed have? 6 of them, or if they wanted to get aggressive, 3 half-point cuts. Not very much. They've used up some of the ammunition that they had to combat a recession as what they call as insurance. We'll see. Interestingly enough, to me, I think the Fed's just not letting on, and they're more concerned about an impending recession than they'd like us to know. They can't tell us that. They have to lie. Why? Because if they say that they think there's a recession coming, well, then businesses would seize up and we would accelerate the process. So the Fed's just telling us, nothing to see here. Everything's okay. This is just for insurance. All good. But I think there's more than meets the eye. All right, team. I hope that you guys get on board with MBS Highway because we've really navigated these very treacherous waters extremely well. We should be doing that for you, for your customers, but it's not all about rate. We've got so many tools that will help you. If you just took a look, you'll be blown away. Hope you guys have a great day. See you next week.
PRMG continues to provide our wholesale partners across the nation with better technology, better product, better pricing, and better service. Our nationally recognized brand is more than just an image. It is a symbol of integrity. PRMG, built by originators for originators. Be sure to click on the link below for your free 30-day MVS highway trial.
This is Mortgage News Network.